Hello everyone, and welcome back to the Web3 Daily. Today, the market went through what can only be described as a breathtaking tug-of-war between bulls and bears. Bitcoin broke below the critical psychological support of $110,000, and although it has now painstakingly reclaimed that ground, with Ethereum also bouncing back above $4,000, let's be honest, the market's nerves are still incredibly frayed. The driving force behind this volatility is clear: massive institutional sell-offs. Data shows that US spot Bitcoin ETFs alone saw a net outflow of over $500 million in a single day, and that was the second consecutive day of outflows. There are even rumors circulating that giants like BlackRock, Binance, and Coinbase moved or sold $1.1 billion worth of Bitcoin in just 6 hours. That's a powerful signal of immense short-term selling pressure. In this kind of market, those playing with leverage are having a really tough time. Total liquidations of leveraged positions across the network hit a staggering $1.18 billion, and over 900 million of that belong to traders who were betting on prices going up. This tells us that the market sentiment was definitely overheated before with too many highly leveraged long positions. Now, market sentiment has clearly shifted into the fear zone. Although prices have rebounded from their lows, this feels more like a technical bounce from being oversold. The fundamental pressures haven't been resolved at all. On the macro front, US-China trade tensions are high, and the Fed's rate cut expectations are being muddied by inflation concerns over tariffs. Everyone is holding their breath for Friday's CPI data. So personally, I think it's far from time to be optimistic. There's a heavy resistance overhead, and if we can't break through, the market could very well test the lows again. Everyone should be mindful of the risks and trade cautiously. Alright, let's move on to the hottest topic of discussion across the web today. Yesterday, the narrative of decentralization that Web3 is so proud of was, you could say, dealt a harsh slap by reality. The world's largest cloud provider, Amazon's AWS, experienced a massive service outage in one of its core regions in Northern Virginia. You might be thinking, what does this have to do with us in the crypto world? Well, it has everything to do with it. This incident, which seemed like a traditional internet problem, dealt a heavy blow to our crypto ecosystem. First off, the largest compliant exchange in the US, Coinbase, was completely paralyzed. The mobile app was down, and even their own Layer 2 network, Base, crashed. Many people were complaining on social media that they couldn't log in, couldn't trade, and certainly couldn't withdraw. What was even more terrifying was that many people opened their MetaMask wallets only to find their balances showing zero. This immediately sparked panic in the community. Although we all know the assets are safe on-chain, when the front-end service collapses, you simply can't access them. I'm sure many of you felt that sense of helplessness. It's quite ironic, isn't it? We talk about decentralization and censorship resistance every day, but what's the reality? Our lifelines, the applications we use daily for trading and checking prices, are almost all running on the servers of centralized giants like Amazon and Google. This is actually an open secret in the industry. The protocol layer is decentralized, but the application layer has a fatal single point of failure risk. However, with crisis comes opportunity. This epic AWS outage has ironically become the best advertisement for the decentralized physical infrastructure network, or DePIN sector. Projects like Filecoin and Akash Network are using this moment to emphasize that only by decentralizing infrastructure like cloud, storage, and computing can we fundamentally solve the problem. So, while today's topic might seem like a technical glitch, I believe it could signal a major strategic shift in Web3's development focus. We're moving from the blossoming of 100 flowers in the application layer over the past few years to truly strengthening the foundation of the underlying infrastructure. Because this real-world failure has shown us that solving the centralization problem in our infrastructure is no longer a distant technical ideal, but an urgent commercial necessity. Okay, let's dive into our first major news story of the day. I believe this is a profound structural shift, one that could even reshape the entire valuation logic of the mining industry. While the market is still anxious about price volatility, Bitcoin miners have quietly begun their AI gold rush. The publicly traded mining company CleanSpark recently made it official. They're no longer just a Bitcoin mining company. They're expanding into the realm of artificial intelligence and high-performance computing data centers. And this isn't an isolated incident. I'm seeing companies like Hot8, Hive, TerraWolf, and the already successfully transitioned CoreWeave all pushing in this direction. Why? The logic is actually quite simple. It's a classic push-pull scenario. On one hand, there's the push. The Bitcoin halving slashed their block rewards in half, and with energy prices on the rise, mining profit margins are getting squeezed thinner and thinner. If they don't find a new path, they're just waiting to die out. On the other hand, there's a massive pull. The explosion in AI, especially large language models, has created a practically bottomless demand for computing power. And what's the most valuable asset these miners hold? It's their existing industrial facilities with cheap, stable power and cooling systems. These assets have suddenly become hot commodities for tech giants. The most significant aspect of this transformation, in my opinion, is the reshaping of their business model. How did we used to view mining companies as cyclical commodity producers? They produce Bitcoin, so their stock prices follow the coin's price, full of uncertainty. But now, as they transition into AI infrastructure providers, their revenue shifts from the volatile income of mining to more predictable, long-term computing power rental contracts. Their business model becomes more like that of a data center or a cloud services company. This could attract a whole new wave of traditional institutional investors looking for stable cash flow, and their entire valuation model could be rewritten. Of course, the path from mining to training AI isn't exactly a walk in the park. Technically, the operational complexity of an AI data center is far greater than that of a mining farm. Financially, buying top-tier AI chips from NVIDIA requires an astronomical upfront investment. And in terms of competition, they're not just competing with each other, but also with cloud giants like Amazon and Google. Therefore, we're likely to see a significant divergence in this industry in the future. Only the top-tier miners with the most capital, the cheapest power, and the best technology will be able to make this magnificent turn. Now, let's shift our focus from the industry over to the political arena, because recently, a very high-level, closed-door meeting took place on Capitol Hill, and it's something that could directly affect all of our wallets. On one side of the table, you had Democratic Senator Kirsten Gillibrand from New York, and on the other side, some of the biggest names in our space: Coinbase CEO Brian Armstrong, Galaxy Digital founder Mike Novogratz, and Ripple's chief legal officer Stuart Alderodi. So what were they all discussing? The core issue was trying to break the current gridlock on crypto regulation in the United States. This gridlock is really rooted in a deep partisan divide. The Democrats are reportedly drafting a completely new framework with a major focus on strengthening DeFi oversight. The Republicans, meanwhile, are sticking to their usual playbook, insisting on drawing clear jurisdictional lines for the SEC and the CFTC. As a result, Wall Street analysts are basically saying not to expect any substantial legislative progress in the short term, likely not until after next year's midterm elections. But here's my take. I think the symbolic significance of this meeting is far greater than any immediate problem it can solve. This signals that our industry's political lobbying strategy is maturing. In the past, we were mostly reactive, responding only after a bill was introduced or a regulatory action was taken. But this is different. You have CEOs engaging directly in closed-door strategic dialogues with key Senate figures. This is a more proactive, high-level diplomacy approach. Furthermore, this meeting also points us to the future main battlefield of the regulatory fight. The Democrats' emphasis on DeFi regulation is definitely not just talk. Because centralized exchanges like Coinbase are relatively easy to bring into the existing framework. But DeFi, how do you legally define a DAO? How do you implement anti-money laundering on a protocol? Should code developers be held liable? These are the toughest nuts to crack in the future, and the core battleground between the industry and regulators. So, this meeting, you could say, is the prelude to this long-term game. This next piece of news is really interesting to me because it shows just how intense the competition in the public chain ecosystem has become, so intense that founders are now personally getting in on the coding. I'm talking about Anatoly Yakovenko, the co-founder of Solana. He recently did something major. He personally designed and open-sourced a new decentralized exchange protocol called Percolator, and it's aimed squarely at the hottest market right now: perpetuals. So why is he going to such lengths? To put it bluntly, he was forced into it. His user base was getting poached. A little while ago, the well-known asset management firm OneEck released a report that specifically pointed out that a perpetual stacks on Arbitrum called Hyperliquid was aggressively poaching high-value traders from Solana. And just how powerful is this Hyperliquid? The report stated that in July, its protocol revenue accounted for a staggering 35% of all blockchain revenue combined. It was single-handedly siphoning users and liquidity from Solana, Ethereum, and BNB chain. Faced with such a strong competitor, Anatoly couldn't just sit back. He took matters into his own hands and designed a technically superior solution. This percolator, to put it simply, is a sharded or modular exchange. The core idea is to isolate different trading pairs, like turning one massive, crowded central trading floor into many independent trading rooms that don't interfere with each other. This way, even if trading volume for one popular coin explodes, it won't cause the entire platform to lag. I think this event marks a new paradigm in public chain computation. In the past, a public chain's role was more like a real estate developer. Build the infrastructure and you're done. But now, applications are king. Chain founders have to step out from behind the scenes and become proactive ecosystem builders, personally getting involved in deploying those killer apps to ensure their home turf has the sharpest spear and the thickest shield to survive this brutal ecosystem war. If this design for percolator succeeds, it will be a critical step forward for DEXs in catching up to centralized exchanges in terms of performance and user experience. Okay, let's get to the next story, which I find particularly interesting because it could signal a major convergence between the traditional payments industry and our crypto world. The main character here is the global fintech heavyweight, Wise, formerly known as TransferWise. This company is famous for its low-cost, high-efficiency global remittance services and is a legitimate publicly traded company. Recently, a seemingly ordinary hiring move has revealed their big ambitions. They're publicly recruiting for a digital asset product lead at their London headquarters. And the job description explicitly states that the focus is on stablecoins and exploring how to enable Wise's millions of global users to hold and use digital assets directly in their accounts. This move represents a complete 180-degree turn in Wise's stance. For the past decade, Wise executives have repeatedly expressed skepticism about blockchain technology, believing that their own network of global bank accounts was faster and cheaper for transfers than using cryptocurrencies. So why the change of heart now? Because the market has changed. The stablecoin market has now surpassed a total market cap of $300 billion. More importantly, it's no longer just a tool for us insiders to trade with. It's becoming a real-world payment medium. Especially in cross-border remittances, Wise's core territory, the advantages of stablecoins are becoming increasingly apparent. Reports show that in places like Latin America and Africa, a large number of regular users are using stablecoins for small cross-border transfers because it helps them avoid local currency devaluation and offers much lower fees than traditional channels. Therefore, I see Wise's entry into this space as a form of defensive innovation. Their business moat is being cheaper and faster than banks. But now, Web3 native payment solutions can theoretically offer even lower costs and faster speeds, which directly threatens Wise's foundation. Rather than waiting to be defeated by an external disruptor, they are proactively embracing the very technology that could potentially kill their own business. Of course, for Wise to integrate stablecoins, the real challenge probably isn't the technology itself. It's about finding that perfect balance between strict compliance and an ultimate user experience. As a heavily regulated public company, it must adhere to the strictest anti-money laundering regulations. But at the same time, if using the product requires the average person to understand concepts like private keys and gas fees, then the product loses its purpose. So its success will depend on whether it can create a frictionless product that is both fully compliant and makes users feel like they aren't even using cryptocurrency at all. Alright, but while the traditional finance giants are looking to get a piece of the pie, another group is also watching hungrily, and that's the hackers and the scammers. This next story is a major security wake-up call for all of us. Recently, Europol, in collaboration with Latvian police, took down a massive cyber phishing syndicate. When I saw this news, honestly, the numbers were pretty chilling. This group was running a huge SIM farm, using over 1,200 devices to control more than 40,000 SIM cards to carry out automated scams. They've been linked to at least 1,700 digital fraud cases globally, involving a staggering 49 million fake accounts, and they stole at least 5.7 million euros in Latvia and Austria alone. And their methods were extremely professional. This wasn't just about sending a simple phishing link. It used complex social engineering, impersonating friends, family, law enforcement, and even using illegal materials for blackmail. Most importantly, these guys really understood our world. During the raid, Police seized about $330,000 worth of various crypto tokens. What does that tell you? It shows they weren't just targeting us for scams, they were expertly using cryptocurrency for money laundering and transferring their assets. To me, this signals that crypto crime has entered a terrifying industrialized phase. We're no longer talking about a few lone hackers. This is a well-organized, highly specialized, tech-driven criminal enterprise. From the hardware and the scripts to the back-end money laundering, it's a complete industrial chain. The opponents we're facing now are professional criminal organizations. This case also exposed another vulnerability. Criminals are cleverly exploiting the cracks in legal jurisdiction between different countries. The report mentioned that because most of the victims were Russian-speaking, and Russia is not a member of Europol, it made the investigation and evidence collection extremely difficult. So, the only way to combat this kind of transnational crime in the future is to establish more efficient international judicial cooperation. This cat-and-mouse game has just leveled up. And for our final story today, this one, in my opinion, goes beyond the crypto world itself. It reads more like a suspense thriller, weaving together politics, business, and international relations. The Guardian recently published a deep dive investigation, and it's aimed directly at the son of former US President Trump, Eric Trump, and the crypto mining firm he partially owns, American Bitcoin Corporation. The other party in this story is a name everyone in our circle knows, the Chinese mining giant, Bitmain. So what's at the heart of the report? One phrase, a sweetheart deal. Documents show that Bitmain gave American Bitcoin Corporation preferential access to technology and unusually beneficial payment terms to buy hundreds of millions of dollars worth of mining rigs. And here's the wildest part of the operation. American Bitcoin didn't pay with cash. It paid with pledged Bitcoin. And here's the kicker. This pledged Bitcoin could be redeemed up to 24 months. That's 2 years later, at the price it was when the deal was made. What does a 2-year window mean? Well, industry experts pointed out that the standard redemption period Bitmain was offering other customers at the time was only 6 months. So what does that extra 18 months amount to? It's essentially Bitmain giving Eric Trump's company a massive, almost zero-cost loan that also comes with a huge potential call option on Bitcoin. Just think about it. Eric Trump himself has publicly predicted Bitcoin will hit $1 million. If the price really does surge within those 2 years, they could use a smaller amount of newly mined Bitcoin to get back their original pledge, which would have skyrocketed in value. It's practically a free ride. So, that raises the question. Why would a highly influential Chinese tech company offer the son of the sitting Yu as president such incredibly favorable business terms? The Guardian's investigation directly highlights the concern. Is Bitmain trying to use this deal to indirectly influence the Trump administration's decisions on crypto regulation, energy policy, or even U.S.-China relations? I think this incident lays the trend of crypto geopolitics bare for all of us to see. It tells us that this industry is no longer an isolated technological utopia. In the future, a company's national background, the security of its supply chain, and its political connections with various governments will become absolutely critical factors that we cannot ignore when assessing its risks and value. Alright, that's all for today's Web3 Daily Report. If you found this helpful, please remember to hit the like button to show your support. Every day, we sift through the Web3 world to bring you the most noteworthy core information that's closest to wealth. We hope that by curating this selected content, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've prepared exclusive registration links for major exchanges in the comments section below. These are high rebate offers we've secured for our fans, and we hope they can help you save some costs on your investment path. Let's all stay rational, move forward steadily, and get rich slowly together in the Web3 world. May every one of our friends see their crypto assets grow steadily. We'll see you tomorrow.